Well, our next guest says, don't fear higher rates, these breaks, embrace them, because that means a return to a more prosperous time. The bigger worry should be the macro conditions that would force the Fed to cut. Joining me now for more is Chris Grisanti, Chief Equity Strategist and Senior Portfolio Manager at MAI Capital Management. Chris, welcome. So things are pretty good, and that's why the Fed's doing what it's doing or not doing what it's not doing. And you say that's fine. Why?
I think it's more than fine, John. I think it's necessary. So you don't want lower rates because lower rates don't happen by themselves. The Fed isn't a Santa Claus who's going to give out lower rates as a gift. They'll lower rates when things start to slow down. So I would much rather live with higher rates and a stronger economy. Look, every economy, every market has problems of one kind or another. Otherwise, I'd be out of a job as a strategist. But this problem, which is inflation's running a little hot, rates are a little high, that's a pretty good problem for the equity markets to have. Remember, earnings are reported in nominal dollars, so a little inflation will feed into the earnings, all other things being equal. Earnings should be okay this year. Jobs seem, just fine right now. Who knows what will happen in the future? And I get it that higher rates take time to slow the economy. They don't happen overnight. But look, it's been almost 800 nights since the Fed started to raise rates. The economy's chugging along. I think we should, hang on tight and enjoy the ride and fear a rate cut.
But Chris, for an equity investor in this environment, so many stocks are so richly valued, it's hard to know what to buy. So how do you decide?
Right. So valuation is a problem, John. I wouldn't go out and buy indiscriminately. But, us value investors, we complain about the MAG 7. It's gone up so much. It's unjustified, blah, blah, blah. But the flip side of the MAG 7 is all that capital flowing into those 7 stocks. It's had to come from somewhere. And I think there's a bunch of sectors and specific stocks that have been left behind. I particularly like the healthcare sector right now. I think the slower growth there compared to technology makes it unattractive. But those PE ratios have fallen so low that you can make a decent return even if the market gets more difficult in the 6 to 12 months ahead. So I'd look there, and there's a couple other stocks we could talk about as well.
Yeah, so let's talk about one of the others as well, and that's Meta. Now, I understand that just on valuation, it looks cheap, but Mark Zuckerberg keeps spending all this money, first on the metaverse, now he's spending it on infrastructure, things like NVIDIA, hyperscaler chips. I mean, is it really a value play if they're spending that much on this growth future and we don't know how long it's going to take to pan out?
Right, and look, it's uncomfortable for me as a value guy to recommend a MAG 7 stock. But let's look at the stats. So Meta is the only MAG 7 stock selling at less than a market multiple based on next year's earnings. And yeah, it's not a top line problem, it's a spending problem. This reminds me very much of Amazon 2 or 3 years ago, where their top line was doing just fine, but they were opening warehouses and doing all this stuff, and the bottom line actually got cut. That's not the case here. So Meta is still going to grow the bottom line, simply not by as much, but the top line is really healthy. This is not a slowing company. This is not a slowing economy. This is a healthy economy, a healthy company that's investing for the future, and we can get it at 17 times next year's earnings. So love it.
And Zuckerberg also has a history of saying he's going to spend a whole lot of money and then just spending a lot of money, not a whole lot, and then the stock, gets the benefit. I want to go back to healthcare now.
It's all expectations.
Yes. Yeah. There have been some pockets of exuberance within healthcare because last year the GLP-1 excitement caused the air to come out of certain stocks because the thought was, everybody's going to be skinny and pretty and won't need those things anymore. Turns out maybe not so much. Where are the pockets of the largest opportunity relative to the risk, you think?
Well, I think there's a couple of large cap pharmas that are now selling at single digit PE ratios. I think those are interesting. I also think United Health Group is interesting because the Medicare pricing went against them and all the other companies, and they fell precipitously. And they have a history over 20 or 30 years of managing around that kind of negativity. They can do other things with such a big healthcare company that adjust for that loss of revenue from the Medicare side. So those are the kind of things I take advantage of. Also in healthcare, again, the capital's been sucked towards the weight loss drugs. to the disadvantage of other things that might now look quite attractive.